Hey guys, Boris with BK Force. Welcome to our weekly technicals for June 26th through the 30th, 2016. The post-Brexit hangover. Well, what can you say about the week that just went by that really has already not been said? It's truly been a week of superlatives. Some of you may have traded live with us Thursday night, where we just pretty much went. I think Kathy and I both went 48 hours with 4 hours of sleep. It was a historic night. It truly was absolutely an insane amount of volatility. And the thing I think that is very, very important for anybody who is looking at to trade the currency market for the next several weeks is to just understand that everything that had happened before Thursday is completely different landscape. The markets are going to be very, very different from the time that we traded them just a week ago. What I mean by that is that the volatility, even if nothing happens, the volatility itself is going to take a long time to calm down. And that means two things first and foremost. The most important thing it means is that you have to reduce your size by 1/4, not even 1/2, 1/4 to which you were normally trading. Because that's the only way you're going to be able to ride the very massive moves that are happening in the marketplace. Not only for that, but because you're also going to be facing some very serious spread issues. Spreads are going to go crazy as they have been. I mean, pound dollar on Friday was trading sometimes as wide as 10 wide during the most liquid hours. So you can imagine how it's going to be for the next couple of weeks. And the reason why I think it's also going to be very, very difficult to ascertain exactly where things go is because the situation is much, much more fluid than most people believe. I think the conventional wisdom now, it could be just as wrong about post-Brexit as it was pre-Brexit. What I mean by this is that of course, pre-Brexit, everybody, including us, was convinced that the Remain side was going to win. We were fortunate enough, those of you who've traded with us live, to instantaneously understand that that wasn't going to be the case, and we got short cable early in the game. I just sort of got short risk all the way through. But now, I think the situation could actually be an interesting trap for the shorts. And the reason why I say this is because some of you who are listening to this may already been reading in your weekend news that there is now a petition in front of the UK Parliament to essentially do a redo, to do a do-over, as we say in America, to try and do a second referendum. Now, if you're on the Leave side, you certainly feel that that's sour grapes because it won fair and square by a small majority. But on the other hand, the legislative arguments for a redo, I think are pretty significant because this is a massive transformational change for UK that would affect it not simply through a single election cycle, but potentially for decades to come. And given that kind of what we in America call a constitutional change, effectively, it really requires, at least the argument that the petition makers are making, is it really requires a much greater than a simple majority win. It certainly, under a sense of full national obligation, may require as much as a 60% win to really go into full effect. Whether you agree with that argument or not, I think that argument may actually carry weight. We'll have to see how the UK Parliament reacts. The flip side of all of this, I think is just fascinating, is that the Europeans are clearly not giving an inch at this point. The other piece of news that's coming out over this weekend is that the European finance ministers, it was a finance or foreign minister, I'm not sure. I think it was finance ministers, yes, who basically said, "Hey, you want to get out? Get out tomorrow. Don't let as we say in America, don't let the door hit your butt on the way out." They're playing a very tough line with the Brits, basically saying, no, you don't have 2 years, you don't have all the time in the world, you don't have all this luxury of being in the EU without being in the EU. If you voted out, then get out. We're going to rupture all of our treaties, we're going to rupture all of our contracts. And they're putting an enormous amount of pressure on UK businesses that are, I think, essentially feel trapped from one side and the other as to exactly where things are going to go. So I find it fascinating, just from a geopolitical point of view, the various forces that are in play right now reactively to this. What that means as far as our trading goes, and let's just take a look at our charts and just, here we go. Let's take a look at the pound first. What that means, from us from a trading point of view, is that I think a lot of this vicious volatility is going to continue. Um, my friend Jamie Satel, who's a great technical analyst, had actually reminded me over the weekend that when you look at the prior crises or crises, I don't know what is the crises, the plural of crisis, in UK currency history, when you had the ERM spin out and then the other 1980s crisis, devaluation. What's fascinating about the cable is that, yeah, you have these massive moves to the downside. Then you have these big jumps to the upside as countervailing measures. And very often, and this is the irony of the whole thing, when you look at the weekly candles from those times, they actually end up exactly where they started. And I wonder if we may follow the same pattern, meaning that you're going to have these huge moves up and down, up and down, up and down. As we say, again, also another American expression, it's going to be lots of heat but little light, meaning that at the end of the day, it could just settle down exactly where it stood. So I guess my point is, directionally, yes, it's very, very tempting to just basically say this is going down like a stone into the river, right? It's just going to sink hard because fundamentally, if Brexit actually does become a reality, and if, by the way, the Europeans just simply push the Brits out like tomorrow out of the union, cut off all of their trade agreements, cut off all of the various financing schemes, it's going to create such massive panic in UK assets that what you saw on Friday is just the beginning of the nightmare. And it could very quickly drive cable below 130, possibly even down to the 125s. Very, very, very fast. In fact, at this point, it's almost moot to try to make a prediction. The predictions here are 10% in an hour, which is the kind of stuff that we saw on Thursday night, are completely not unreasonable if we get into this very, very stubborn point of crisis where one side and the other side are not only sort of unwilling to compromise, but actually want to expedite the pain, want to just simply go to war with each other. The flip side of all of this is that I think there's clearly desire on both sides of the issue to just avert a disaster. From the European side, Britain really spinning out of the EU is just the beginning of the nightmare for them. For the Brits, Britain spinning out of the EU is of course a massive, massive hit to the GDP. And regardless of what people say about how it's not going to affect them, how Norway is able to survive and all those things. Nonsense. All of these Scandi countries that are sort of quasi part of the EU, first of all, are subject to almost all of the EU regulations that UK would have to accept. But more importantly, they're all net capital surpluses. They all run capital surpluses. UK is a major debtor nation, much bigger than the United States of America. I mean, basically, it has its whole deficit financed at this point. And what's going to have to happen? The Bank of England is going to have to basically buy up all of UK debt, which is not going to be bought by anybody if the market feels that UK is going to spin out of the EU, because its credit rating and its credit worthiness is going to suffer tremendously. In fact, you could have the worst colossal nightmare where the currency collapses and interest rates actually go up because the creditworthiness of UK becomes about as good as the creditworthiness of Argentina. That's not a scenario I think that's going to be very likely in the near term, simply because cooler heads are going to prevail. But these are the risks inherent in just trading cable as you look around into the next several weeks. These are the themes you really need to be watching. It's not just simply how the currency market is reacting. It's far, far more how the other markets are going to react and affect UK assets, with the currency market being the single focus of attention. So, from a trading point of view, you really have to trade small, trade wide. It's almost it's very much a guessing game to figure out where the supports are. Our last week's resistance supports numbers were actually pretty much dead on. I was surprised at how well they were relatively respected. We said 150 to the top side, which is pretty much where cable did top out in its pre-Brexit euphoria. And, we talked about the 135, which was the major monthly low from 2009. And yes, it pierced it. I mean, look, in wild and crazy markets, you're not going to come within 100 pips of the low. And by the way, that's sort of, I think, the other thing that you need to understand is that if you're using a support and resistance framework, I would give myself at least 300 pips up and 300 pips down from whatever reference point you're going. That means you have to have a zone, a support and resistance zone, just to be able to survive the volatility inherent in the play of the currency. So, as we look at the support resistance now, of course the resistance now comes at 140, and I'll make one caveat to that particular position on the short side, meaning that if the currency gets up above 140, I consider it to be a very attractive sell, with one exception. If the do-over referendum actually has a chance of being done, and if there is some sort of murmurings that the EU may be willing to create some kind of a carve-out compromise to keep the UK within the Union with a little bit more autonomy, both of those things will trigger a massive short covering squeeze, and then you're looking at 45 probably as the reasonable top at that particular euphoric move. So that's why I say be very, very careful and wary of how you short. Always short within a context, or get long within the context, because the context for the next week and a half is going to be critical to how the prices are going to move around. To the downside, it's really 130 now that becomes the central support, and the 125. So basically 130, 125 is the buy-up zone, is the real money buy-up zone in the drumbeat of depression that begins to affect cable selling. So very, very wide ranges still, but the whole range has clearly moved down significantly, 1,000 points from where we were pre-Brexit, because now we're playing defensively. Now the rallies are just simply short selling rallies or short squeezes, and the move to the downside is more fundamentally focused with a very clear downtrend. Technically, we broke every possible trend line. It looks ugly as a trend line break, and suggests that every rally should be sold. But again, caveat on what would be the context of that sell. Now, the second story, the less glamorous story, but one that still had some punch and power, and we like this. We like the short here as a secondary story, is that if we don't come to any kind of resolution, if UK really does decide to spin out, this is not good news for the European Union. Because clearly now the whole drumbeat of all the right-wing parties in Europe, including the Dutch, the French, the Austrians possibly, and definitely the Italians who've been teetering on it. Italy, to me, is the single biggest problem in Europe right now, because it is the third largest economy. I thought it was the fourth, but it's actually bigger than the Spanish economy. Third largest economy, so this is a crux of the European Union. The European Union cannot exist without Italy. But yet, here's a startling statistic. Since, I just want to make sure I get my dates right. I believe, since the year 2000, I mean, not even since the great financial crisis, but since the year 2000, the Italian economy has only grown by 5%. That is 1/3 the rate of the Japanese economy, the sick man of all of industrialized West or industrialized nations. So I think the pressure on Italy is so enormous right now that a spin out of UK will really unleash the five-star nationalist movement and push the Italians out. If the Italians go out, you can kiss the euro goodbye. So euro is just as vulnerable as cable in some ways, and need to watch this pretty carefully. 114, obviously, on to the top side that's the natural support, but unlikely to get up there. Maybe on a euphoric, everything is okay type of a rally in Europe, but generally, we broke the 110s. Like we said, 110 was going to be the very, very key level, and now it just becomes the 109. Really, frankly, almost the 108. That is the natural support in the near term for euro. And then finally, looking at the yen, which was another predictable shocker. We talked about the idea that, hey, if Brexit happens, we see parity to the yen. I just didn't think we were going to see parity to the. I'll be honest with you, I did not think we were going to see parity to the yen in literally 30 minutes. That was insane. If those of you who traded on Thursday, it was so fast. Honestly, Kathy and I we were actually watching cable that we didn't even realize dollar yen went to parity, and we had some of our traders actually point that out to us because we're so fixated on cable. It was such a fast move, but there was a buy up. We actually didn't. We broke parity. We went to like 98 before it finally created a big buy up. There was a lot of controversy as to whether did BOJ step up, did people step up. I don't think even BOJ needed to step up. There was a lot of buy ups. But now, of course, this parity looms very, very large. So this is a risk on, risk off trade that's going to be the secondary reaction in the market, depending on how the post-Brexit resolution comes through. Next week will be dominated by a massive amount of headlines out of Europe, and that's a massive amount of headlines out of UK. If they're contentious, I really think this gets tested back to the 100. So I think you have to be prepared fully for a possible move down to the 100 again. If suddenly love breaks out and we somehow feel a sense of compromise, we may be able to squeeze ourselves back up. Dollar yen recovered quietly on Friday, but I think it's a quiet before the storm. And I think if further political friction comes through across the tape over the next 3 or 4 days, you will see this go right back to parity. So let's just take a look at the charts. I mean, not at the charts, at the levels to kind of confirm where everything stands at this point. So Euro 114, that's a stretch in the best case scenario type of resistance level. I think probably 12 to 13 is where the currency pair really peters out this week. 109 is just the beginning of the support. I think 109, 108 is probably the more accurate support levels where we should be looking at. Resistance in dollar yen, 103 to 105, that was former support, now becomes resistance. And now support back down to the 98s. The only ray of hope if yen gets down to 98 is I think the BOJ is going to step up. I don't think the BOJ can afford at this point to have the yen trade below parity for a considerable period of time, which is why, by the way, you need to be very, very careful if you get short this. You get short this underneath the 100 level. In other words, to the 100 level is fine, but if you get short this underneath the 100 level, be very well prepared for a 200-300 point move in your face in a matter of 30 seconds. Be prepared for the BOJ coming in and doing what we call in the currency market the drive-by, where they simply come in and buy up everybody else's supply and drive the currency pair at 200-300 points in a matter of minutes. Oh. So again, trade yen at a quarter of your normal position, if that, into this particular storm. And of course, with cable, the spread now, the range now has moved to 140, 130, and realistically, really 130, 125 on the downside if we get further downside action. Whichever way it goes, it's still going to be a very volatile week. It's still a completely different world than it was on Thursday. You need to trade smaller, wider, and be constantly aware of the broad general headline moves that are going to be happening. This is not going to be a economically driven market. This is going to be a politically driven market, and politically driven markets in currencies, the moves are vicious, they're wide, and the volatility explodes. So I wish you guys the best of luck and the best of trading on the majors, and I'll see you guys next week.